Everyone. Thank you for those who have already joined live. If you're catching up on the recording or watching the recording for the first time, thank you for tuning in. So I'm excited to have Jonathan Spitz here, who is from Lightstone Direct and has a ton of experience in real estate investing. He was with Origin Investing before this, but it really specializes in this area and field and heads up capital raising for Lightstone Direct. So he's going to talk to us about kind of the correction he's seen with real estate and what he is foreseeing in 2026, which it's always super helpful to have someone of Jonathan's experience kind of share what he's seen as things have evolved with real estate, because it is an area where, the we always say with, the stock market, you're kind of just following the overall market and trends. In real estate, you have a little bit more on the micro level that you can plan for and use to adjust your strategy and successfully investing. So super excited, Jonathan, to have you here and sharing your thoughts and your wisdom. So thank you. And I'll pass the baton to you to kind of get started. For everyone, we will have plenty of time for Q&A. I was just talking to Jonathan before. If you have questions, especially if it's something he's currently talking about, it's super helpful. Just throw them in the chat and we can kind of address them as they come up as well. But we will have some dedicated time at the end also. So, Jonathan, take it away.
All right. Well, good evening, everyone. As Jordan mentioned, my name is Jonathan Spitz, and I lead the capital formation team here at Lightstone Direct, which is just a fancy term for saying I work in fundraising at the company. But so during our time tonight, we're going to provide I'm going to provide an overview of really first just to give you an introduction to Lightstone and why you should even care about what we have to say about the market. And then I'm going to really take a step back and we're going to talk about where we are today in the overall market cycle, where we've been, how that leads to where we are today, and what we think the market holds in store for us over the next 12, 24 months, and how Lightstone specifically is positioning capital, given a lot of what we're seeing in the market and the macro. As Jordan mentioned, if you have any questions, feel free to drop them in. I'm happy to stop at any point and answer any questions and make this conversational. So, with that, let's get started. So, Lightstone, we have actually been around for almost 40 years. Be 40 years this year. We manage about $12 billion in assets and a portfolio that spans over 25,000 apartment units and over 12 million square feet of industrial and commercial space across 26 states. We also manage about 5,100 hotel keys. We own a life sciences and retail portfolio. And right off the bat, that is one of the biggest differentiators about our company is that we invest across multiple property types and have done so successfully for the better part of 40 years. And why that's important is because it enables us to be a bit more objective when we're thinking about where we want to position capital at any point in the cycle. So what I mean by that is if you are a multifamily real estate manager and that's all you do, well, then it's always a good time to invest in multifamily, right? But the fact that we can diversify and spread our bets based off of, what asset classes we think are outperforming and what different markets are outperforming. We're not limited to just one sector or part of the country. We invest in the Midwest, we invest in the Southeast. I mean, generally speaking, we're not east of or west of the Mississippi. We do have some exposure out there, albeit it's very small. And so that enables us to just cast a much wider net. And that's really translated to the strong results you see here on the screen. I mean, over the last 22 years, we've generated almost a 28% net internal rate of return, and that's a blended average across all of our different strategies, and over a 2.5 net equity multiple on invested capital. One of the biggest differentiators about our company, aside from our ability to play across different property types, is just the amount of capital that we invest in every deal that we offer on our platform. I mean, really going back in our 40-year history, David Lichtenstein, our founder, really built most of the business investing his own capital. And what we've done over the last, let's call it, we've really been planning this for the last 2 years. but only recently did we finally launch a platform that enables individuals to invest alongside our company. So, our parent company is called the Lightstone Group. Lightstone Direct is just an expression of the business that enables individuals to co-invest alongside us in the same deals that we are pursuing anyways. That's a really important distinction because these are deals that we are going to do no matter how much capital we raise from outside investors. What I mean by that is in a typical real estate syndication, if you're investing passively, what every other manager in the market does is they, identify an asset, they go out and raise all of the equity from outside investors. Maybe they put a few dollars of their own capital in there, and then they close on said property, right? At Lightstone, what we do is we actually go out and we close on the property using all of our own capital first. And then we backfill up to 80% of that equity capitalization with outside investors. So why that's important is number one, no matter how much demand any of our offerings get, we always will have at least 20% of our own capital in the deal. But if we don't raise it all, then we'll own 30, 40, 50% of the deal. So taking that type of risk is just a different level of alignment and skin in the game relative to other asset managers in the space. Now, before jumping too much into where things are going, I really think it's helpful to set the table and talk about where we've been. And I really love this. I use this graph a lot when I'm giving talks like this, and I think it's really the best illustration that I've seen that really simplifies what the real estate cycle is and the four phases that are associated with that. So generally speaking, phase one is the recovery, right? And so that is, and I'll explain why, and this is the phase that we think we're in today. This then follows an expansionary cycle where you start to see development activity pick up, occupancy drops, property valuations rise, transaction activity returns to the market, and then you hit a hypersupplies phase, right? Which is what really, and I want to start talking about this phase of the cycle because it's very recent that we were actually in this phase of the market. So if you really go back to, let's call it 2020, we all know where we were in early 2020, right? Like interest rates went to zero, COVID had started, and really real estate became incredibly popular. And it made a lot of sense why. You were seeing massive migration trends happen across the country. There was a big flight south to the Sun Belt for various reasons. And so with that came a huge incentive to build. And so because the cost of capital had dropped so low, and so that's really what really ignited this hyper supply part of the cycle that really lasted from 2020 to 2022 and really resolved in 2024. And so what happened is, especially in apartments and warehouse space, which is really what we'll talk about mostly today, you saw 40, 50-year highs in new supply getting built and then subsequently delivered to the market. Now, that was the start of phase four, which was the recession, was you had an overbuilding that happened that was fueled by structurally lower interest rates. But what also happened, and which was pretty unique, is that you also had the quickest spike in interest rates that we've ever seen in history. So we saw the Fed funds rate go from practically zero to almost 5% in relatively short order. And for those of you that are experienced in real estate, you understand, I mean, real estate is a business that's largely built on leverage and debt. Because it's a capital intensive business, most of the time, whether you're buying your house or a rental or when we buy an industrial property or an apartment building, we are using financing. And so when the cost of financing rises that much, that has downstream implications to the valuations of those properties because it affects how much someone can pay for them. And so you have this really 1-2 punch in the market of really a 40-year high in supply and the most rapid interest rate hike in history. And that's really the market that we've been experiencing for the better part of 3 years now, really going on 4 years. You've seen a gradual reset in property valuations. And I'm going to show you what this looks like in a few charts in subsequent slides. But again, this is all cyclical, right? And as a result of these higher interest rates, what we've now seen is also that future supply has dwindled significantly because no one's been able to get developments off the ground. And so let's talk about where we are today, right? So over the past 3 years, we've seen multifamily and industrial valuations fall between 20 and really 40%, depending on the property type and the market, et cetera. We've really seen a reset in property valuations that are now more appropriate for a higher interest rate environment. And we've seen a significant decline in new completions when it comes to construction and development activity, and we expect that to continue in subsequent quarters and years. So whether it's multifamily or industrial, you're seeing 30, 50, 40, 50, 60% declines in new supply. And again, what some of the data shows us with starts is it's not like too many projects are getting off the ground for a lot of the same reasons that I talked about. Now, what's been really interesting though, what makes this real estate recession, and that's really what it is, it's very much a concentrated recession that's really been isolated in the real estate space specifically. It's probably one of the more hated categories out there. Just go look at publicly traded REITs. And that's one of the reasons, that's one of the things that gets us incredibly excited, right? But when you really peel back the onion and look under the hood, fundamentals have been incredibly sound. What you saw in 22 and 23 was a lot of these funds go out there and advertise that they're raising distressed funds and they're going to pick up all these properties for cents on the dollar. It's a repeat of the great financial crisis, and none of that materialized in any meaningful way. Why is that? Well, because if for properties to default, well, they occupancy needs to be down. Generally, what that means is if a property defaults, it means it cannot meet its debt service coverage payments. But that's not what we've seen. Vacancy or occupancy is largely held up both across multifamily and industrial, where we're seeing, within historical ranges, 95% occupancy, 93% occupancy, which is, especially when you look back over history, very stable type of fundamentals. Yes, rent growth has suffered because of all the supply, but it's still not impacting borrowers from their ability to meet those debt service payments. And this really just illustrates exactly what I'm talking about, right? We saw really what you see in this chart here is right around this 2022 timeframe, is you saw this, really this hockey stick almost go vertical growth in new supply hit the market in industrial and multifamily supply. And again, that put pressure on downward pressure on rental rates. And now we expect to see, really 65% plus declining completions by 2027. And this is data from CoStar. So, what you see is supply levels actually probably going back to more like 2013, 2014 levels. So we think that this is a really favorable backdrop that can help with reignite rent growth. And why that's important, if you've really had to boil down real estate valuations, if you could correlate it to one specific variable in underwriting, it's rent growth. Generally, if you are in markets or in property types and asset classes that are generating strong rent growth, all else being equal, you will outperform everybody else. And so this is what we want to see is this type of, and so we think this is a really good environment to get excited about, whether you're out going and buying out real estate directly or you're going out and doing it passively. I think it's really helpful to understand where we are in this cycle and what we pay attention to at Lightstone as we think about where and how we should be buying. Now, what this is showing is just more of a visual indication of what I referenced earlier in the decline in property valuations. Now, what I wanted to show people is how rare these types of occurrences are. So the last time we saw a decline of this magnitude was really in 2007 in the Great Financial Crisis. And obviously hindsight's 2020, but if you were buying during that point in the cycle, you will have done incredibly well. Now, I don't want to make it sound like this is the Great Financial Crisis because, as I mentioned earlier, the opportunities to go out and buy properties for cents on the dollar, by and large, does not exist unless you want to go play in the office space, in which case you have plenty of opportunity. But you really would want to be careful going down that road. And so why we want to show this is that generally buying after massive repricing events like this is generally going to lead to strong outcomes over time. And again, we've really seen that. And what I like to show too, because it's a common follow-up question I get is, well, how do I know I'm not catching a falling knife? Right? And that's a very valid question. And so really what we look at is what is the transaction data telling us? Because what we had for a long time was this standoff in the market. You had sellers that were not willing to sell. They were still married to 2021 pricing, and they didn't have to sell because fundamentals were still holding up relatively well. And then you had buyers to say, I can't pay that multiple anymore because my borrowing costs make it cost prohibitive for me to do so. So you had this what we call a bid-ask spread that was not pricing. So there was no transaction volume for the longest time. What we've seen over the last 6 to 12 months is transaction volume was up 60% year over year by the end of 25. So what that tells us is that that bid-ask spread is starting to narrow and transactions are getting done. And so that has to do with not just pricing, but the financing environment is also improved. And that's what this slide shows right here. Now, what this is showing is this is the net percentage of banks tightening lending standards towards commercial real estate lending specifically. And so what you basically to kind of explain this chart is the higher number, that's the larger percentage of banks that are essentially not lending to commercial real estate. And so what you saw in 2022 was when interest rates repriced, banks said, wait, okay, we need to stop making loans. We need to reassess our own portfolios. And so they made it incredibly difficult, if not impossible, to get financing for commercial real estate projects. Now, what's happened is as there's been more certainty in the market, they've started to work with their borrowers, understand what their portfolios look like. Now banks have become incredibly active again. And we're seeing this firsthand at Lightstone, which is, maybe if it was 18 months ago, you'd go try to finance a deal and you'd get two term sheets, right? And you'd have to put up a 10% deposit covenant and you'd get very conservative leverage where you need a lot more cash equity into the deal. Now, banks are starting to increase the leverage a little bit. Not in a scary way, but instead of 50% loan to cost financing, maybe they're doing 60% again. And spreads have come in. I think not to get into a talk about credit spreads, but generally speaking, when you have more competition amongst these lending institutions, pricing generally tightens, and that generally means better interest rates for borrowers. And so the confluence of all of these factors is leading to, again, us to believe that we are now entering the recovery phase of a real estate cycle. And again, when you enter a recovery phase like that, this is not something that ends this year or next year or the year after. So we think this is going to be much prolonged, a slow recovery, but a recovery nonetheless. Now, I think it's really helpful to add context because I actually didn't know this until fairly recently. I've been in the real estate business for 12 years. Is that when you look at 40 years of returns, the attribution of returns. So how you make money in real estate is two ways, from income and from capital appreciation. Now, when you look at the vintage of assets in decades, what you notice is from in the 80s, 90s, and early 2000s, income would make up anywhere between 60 and 70% of the overall return. Now, the one outlier, the 2010s, where appreciation actually made up the lion's share of returns. Why was that? Well, because we were in structurally lower interest rate environment. So as interest rates decreased, so did cap rates, or and that meant that people would pay you a higher multiple on the same earnings. So as an example, if I bought a property in 2015 as an example, and let's say I got no rent growth, I did nothing to the property, and I held on to it for 3 or 4 years, I would have gotten paid a nice healthy premium in capital appreciation because over that time period, interest rates fell, cap rates fell, and that meant that people would pay more for that same stream of cash flows. So that is unique relative to what history tells us. And so we think that the next 10 years or the next cycle will not look anything like the most previous. And we are returning to what's more a historical norm of where cash flow makes up more of the expected return that you will earn from real estate going forward. And so as an example of this, cap rates got as low as 3% in multifamily. Like there's just no income could be earned from that high. Now cap rates on multifamily are 5%, depending on the market, and 5.5%. And so we've seen some expansion there. So we think that again, we income will be a much bigger driver to overall returns. And operational execution will also matter more. And again, what I mean by that is there were a lot of instances of this, and I know this both and working with my previous firm, and I think any manager, if they were being honest with you, would say they had a deal that they got lucky on, meaning they went and bought a property, they executed this value add business plan, they thought they were going to get some uplift in rents that never materialized, but the market would essentially bail them out because multiples had expanded and cap rates had come down. And so for those and maybe if you don't know real estate and don't know these terms, let me just explain what a cap rate is. I'll try to break it down in terms of price to earnings ratios as a way to think about it from a public market standpoint. So if I buy a 5 cap, that's a 20 multiple on earnings, right? If I buy a 3 cap, that's a 33 multiple on earnings, if you're thinking about it from like an Apple shares or something like that. So it's going to take me 33 years to get my money back, essentially. Now, so now what that allowed for were unsophisticated managers to find success, right? Now, what the next decade we think, or the next cycle will have in store, is it's not going to be as easy. It's going to require much more skill in figuring out managers. You have to know what you're good at. And at Lightstone specifically, what we're really good at is really hands-on asset management. We're a vertically integrated manager. We know how to create value at the property level and how to make money on the buy, right? We can use our balance sheet to close on deals quickly and buy deals at what we believe is an attractive price. And we think that all of these different ways, how you make money on the buy, during the hold, and the sell, are going to become more critical to the overall returns. And then the last part is the selectivity across markets. And so what I mean by that is, what we've seen again is, the Sun Belt was a massive outperformer from 2017 to 2022. But now you've seen the Midwest and parts of the Northeast start to outperform. And that's largely been dictated by those supply demand fundamentals. So now the interest rates are not going perpetually lower because that's a tide that lifts all boats. That now you're going to see much more dispersion in returns across markets. So our focus, we want to be focused on sectors with strong tailwinds. So for multifamily, focusing on affordability in markets that are supply constrained. We don't want to be the most expensive rental in town. We want to focus on that renter by necessity category, which is people that they don't want to pay $2,000 a month in rent. They want to pay $1,300 to $1,500 a rent. In industrial, that means focusing on markets with strong reshoring trends, strong manufacturing, and e-commerce obviously is a big, strong, long tailwind. So these are secular structural tailwinds that are beneficial to the industry, regardless of what happens with interest rates on that side of the house. Again, we want to focus on supply constrained markets. So in multifamily, we were actually in that 2019, 2021 period, we were actually quite active in the Midwest. And I remember working at my former firm in 2020, and I mean, no one wanted to touch the Midwest, right? And now that has been the best, and has been for the past couple of years, one of the better performing markets when it comes to rent growth, income, and overall returns. We also want to be focusing on buying deals at significant discounts to replacement costs. So, we just acquired a 6-tenant industrial park. We paid $69 a foot. It costs you $130 a foot to build that property today. Why does that matter? Because that industrial building that's $130 a foot cannot charge the same rents that we can charge. So it's a competitive moat in many ways. And then as I mentioned earlier, we want to prioritize cash flow, and then we want to be able to increase that cash flow using our hands-on active management strategy. And so that kind of really ties back into what we think and why we think this market is going to be different this time around. So where are we deploying capital right now? We focus within the broader multifamily and industrial categories. We're focusing specifically on what we would consider shallow bay industrial real estate and workforce housing apartment multifamily. So shallow bay just means most of the development activity over the last several years has largely been centered on large 500,000 square foot facilities million square foot facilities that cater towards the Amazons of the world or the Bob's Discount Furniture as a random tenant, but I'm just throwing one out there, or Walmart or one of these larger organizations. And but there are a shallow bay industrial real estate or mid bay is smaller suite sizes, anywhere between 10,000 and 150,000 square feet. And we like to focus on this category because your universe of potential tenants is significantly larger. So you can have businesses that support the local manufacturing base. Like for instance, the deal we just bought in Greenville, Spartanburg, 3 of our 6 tenants support BMW's global manufacturing plant that's based there in Greenville, Spartanburg. But that same building also has a third-party logistics company, has a construction materials company, and a packaging company, and a company that does light manufacturing for train doors. So my point being there is there's just a much wider, much larger universe, and that's why when you look at shallow bay industrial real estate specifically, vacancy rates are generally much lower than what you see in other parts of the market right now. On the workforce housing side, again, what we want to focus on is, I think where most managers get the workforce housing math wrong is what it truly costs to operate a building that was built in 1980 or 1985, right? No different than if you own an older house, right? Like if, like you've got to replace everything from time to time, right? You've got to replace the roof when you're, paint, plumbing, like plumbing issues. Like it's no different than when we buy an older building. But what's unique about what we can do is we can use our insights from our 25,000 unit apartment portfolio as a way to triangulate what the true costs of ownership are and making sure that we're underwriting everything conservatively. But again, what we like is that we're somewhat insulated from new supply because if someone's going to go pay $2,000 a month for a new Class A building, we're charging 1,300. We're just dealing with different types of tenants, and that's all right. But while you're seeing more municipalities start to think about affordable housing in a big way and incentivizing developers through property tax abatements and other programs to set aside units for affordable tenants, that's still a very small part of the overall supply right now. So we feel really good about that from a competitive standpoint. So again, really won't spend too much time here. What we focus on buying buildings below replacement cost, smaller, mid-sized buildings. And I would say we really want to be clustering assets. And I'm sure even if you own real estate directly, clustering is just a fancy term of you want to be owning multiple properties in the same market. And if you're owning properties directly, that makes a ton of sense because whether you outsource third-party manager or your handyman, that you can use that same handyman for 5 properties as opposed to hiring different ones in different markets, same concept, right? We're just doing it at a different scale. And so, really like what you see on here on the right is in Harrisburg, Pennsylvania. We own about 2 million square feet there. It's spread across 9 properties. And again, if you look back at our overall portfolio map, you'll see we do this in a lot of different cities and states across the country. And this just really speaks again to the supply demand fundamentals that I mentioned, saying, if you look at the red line on the chart on the left, what you can see is, how much supply was developed in larger multi-tenant or single-tenant facilities relative to U.S. shallow bay. And that's, so people will ask, well, why is that? Like, why aren't people developing this? And there's like good reason for it. I mean, the one advantage to building a big warehouse for Amazon is then you get the Amazon credit. Well, when you're dealing with the types of facilities that we are, these are not the same types of tenants. That doesn't make them bad businesses, though. And that's really where we can use our asset management team to try to understand, separate who the good tenants are. And that's a big part of how we add value at Lightstone. As an example, last year we executed 23 leases, or about 1.3 million square feet of industrial space. And 19 of those leases were ahead of pro forma, all mostly dealing with this category of tenants, right? These are not mom and pop shops, but let's just call it small to medium-sized businesses. And so again, that's what we like. We like when there's more demand and less supply. And this just again really speaks to our industrial portfolio. And again, talking about really what you've seen, especially in certain markets, is higher vacant. Like What's unique about industrial is it's so easy to paint the whole category with a broad brush. So you like as an example, an advantage or something a dynamic we took advantage of in Austin, Texas was if you look at the headline vacancy number, you see 12, 15% vacancy. But again, once you peek under the hood, you notice that most of that vacancy is coming from those 500,000 square foot to a million square foot plus facilities that were all built on spec. But the shallow bay vacancy was significantly less. And so we bought a property there last year, and it's actually been ahead of pro forma. And that's what you see here is that, a lot of our leases that we're executing are significantly above our original pro forma projections. Now, same goes here, not to reiterate on what I mentioned about just our strategy. And again, we're not married to a particular part of the world or a part of the country. We like the Southeast. Yes, there's been a lot of supply for good reason. I mean, there is a true structural migration story happening in markets like Texas and Florida and the Carolinas. The problem that we have is that the price you pay matters. So, like, it just becomes incredibly difficult in these markets if you're going to go out and buy. And this is the reality of today. If you went to go buy Class A multifamily or even Class B in some of these markets, you would pay sometimes a sub 5% cap rate. You can't borrow for that cheap right now. So people are literally, that's what's called negative leverage, is that I'm borrowing at an interest rate that is above the cap rate that I'm buying at. That just doesn't make sense. And so we're certainly not interested in playing that type of game. But look, we've found deals here and there, right? We have 570 units in Florida, 1,300 in Alabama, less than 300 in Texas. But then look at Michigan, Illinois, and Ohio, right? We've got almost 10,000 units. We'll have 10,000 units quite soon in Michigan. Illinois, 1,500, Ohio, 2,500. So these are the markets that have been really showing really strong rent growth, and where we've been focusing our time. And again, talking earlier about those secular demand drivers and what that means, I like to show this chart because it's showing the delta between owning a home and renting. And I don't think this is like a surprising chart to show to anyone on the call. I think we all know whether you rent or whether you own, it's much more expensive once you factor in taxes, insurance, maintenance, mortgage. Once you factor all of that in and you try to compare it to a rental, you're generally paying over $1,000 a month more to own than there is to rent. And that's not a bad thing, but that definitely it just reduces the amount of potential buyers and actually creates what we would consider a trapped pool of renters. So these are people that may even want to rent or buy but can't. So that is, and what that's created is incredibly strong demand, and that's what this chart shows. So if anyone remembers what rental demand was like in 2021, we hit all-time highs. Well, we actually just exceeded that in 2025. So demand has been incredibly strong. The difference now is that there's much more supply to absorb that demand. And so you haven't seen the uptick in rents. But what you have seen is stable fundamentals, right? And again, this really just speaks to what I mentioned earlier is that workforce housing category that we focus on at Lightstone, which is really, again, people that make, 50, 40,000 to, 80, 100 to 100,000 a year that don't want to pay top of the market in rents. Like I live in Tampa, Florida. Like there's buildings being built. I don't know who's paying these rents, but people are paying $3.50 a foot in rent. So which means if you rent 1,000 square foot 2 bedroom unit, you are paying $3,500 a month in rent, which is insane to me for no space at all. But if you are on the call and you're in New York City, you're probably laughing at those numbers. So, but that's just an example of kind of where we've gone. And again, there's just such a need for affordable housing, and that's where we focus. So this is just a live example. I won't spend too much time on this of exactly what we look for. This is a building we acquired in December. We're currently raising capital for it right now. Really exemplary of what we look for specifically when it relates to the industrial opportunity I've been speaking about, right? This is a property that was built in the 80s, 83, and renovated in 2015 over the course of 10 years. And we bought the property at $69 a foot. Cost you $130 a foot to build this property today. right? Greenville-Spartanburg is one of the fastest growing industrial markets in the country because you can get to Charlotte in 2 hours or an hour and a half, Atlanta in 2 hours, and Charleston in 3 hours. So you can access 31% of the US population within a day's drive. And our plan here, 100% lease building, we pay monthly distributions between 6.5 and 9.5%, basically. And you know, we are targeting roughly a 15% internal rate of return on a very low risk business plan execution. So this is what we mean by today is that you're starting to see good opportunities. We like to say that we like to hit singles and doubles. It's funny because I'll talk to people and they'll be like, we're the 25 IRRs. And it's like those days are kind of over for now. And that's not a bad thing. Like again, sure, maybe you can go try to, swing for the fences. What we've noticed, and trust me, we've talked to many banks about distressed opportunities. The risk reward on those types of opportunities just is not there, in our opinion. And again, what we focus on is cash flow first, wealth preservation, downside protection by acquiring at a decent basis, with opportunities to create value and increase that cash flow over a 4 to 5 year holding period, and deliver tax efficient yields to our investors. So any of our investors that participate, they get all of the same depreciation benefits to owning that real estate. They don't pay or they defer the taxes on the gains for any of that income that they're earning. They'll have the opportunity to execute a 1031 exchange with us into our next deal. I mean, that's really how you make money in real estate. And that's why real estate is so attractive, is because there are between 1031 exchanges and depreciation, you have mechanisms that you don't have in other asset classes as a means to not pay taxes or defer taxes. And so we try to implement those and allow investors to capitalize those, doing that in a passive manner through our open investment opportunities. So that's it. That is all my time. This is my contact info below. If anyone wants to talk more about anything I said, whether it's just the broader market, our offering specifically, or what we do at Lightstone, this is my contact information. This is my colleague Storm Murphy, who's my partner at the firm. And again, we always just love having conversations with people about real estate. So again, really appreciate the time, Jordan. Hope this was helpful and beneficial for people. And I'll kick it back over to you.
All right. Yeah, no, that was incredibly helpful and definitely a lot of things that I learned. I think even just seeing that graph of, kind of the different phases of the market and, hearing you go through that and spending that time was incredibly beneficial. I encourage everyone to definitely throw some questions in the chat and take advantage of this opportunity to really pick the brain of someone who is definitely an expert in real estate. The other thing I loved hearing was about how you're talking about, we try to hit doubles and singles, and that's kind of like a phrase I'll use like in surgery a lot too, instead of you got to balance the risk and the reward, and sure, everyone maybe wants to try and hit a home run, but you're especially with investments, there's no called strikes on investments, to kind of continue the baseball analogy. And you just want to go for reliable. You're doing this to build wealth, to build your passive income, to build towards financial freedom. And there's no need to take on excess risk that you just don't need to.
Yeah,
Can
100%.
you've kind of hit on it a little bit throughout, but can you talk a little bit on like your underwriting process and sort of what your general philosophy with that is? Just in maybe like give a concise kind of uh, you know, one liner, like this is our philosophy and how we underwrite, because it seems like you guys are doing a good job of underwriting conservatively and building in for contingencies, and you're often over um you're you know creating returns beyond what you're even underwriting.
Yeah, so I think that the first part of that is we try to not we don't trend rents generally, and we always expand our cap rates on the exit. So what you'll see a lot in passive real estate, I would say there's three parts of that. Leverage, so how much debt we're using, what are the multiples, and what's the in the rent growth. So I'd encourage anybody that if you are looking, whether you're modeling a deal yourself for your own investments or whether you're looking at passive investments, if you see some like eye-watering type of returns, you want to pay attention to three things in the model to the extent that they'll show them or you can see them. One is what type of rent growth are they projecting? Two, how much debt are they putting on the property and what are the terms? And three, what is the exit cap rate that you're going in at? So as an example, I can make my model look incredibly spicy if I buy a cap rate at a 5.5%, and I tell you I'm going to exit this property, or I'm going to create this value in a deal, and then I'm going to exit at what I say a 5.5 cap was what I bought it at. Let's say I'm gonna exit at a 5 cap. So I'm compressing my cap rate over the life of the investment. That is a big no-no in underwriting. Typically, what you want to be doing is actually expanding the cap rate. Why is that? Because if you are, if I am creating all of the value in the deal, then whoever's actually buying it next, they will not give me that they will need a higher return because there's no other way to make a return. There's no other way to earn money. So that's just more prudent is you exit caps, do not compress, expand. So whatever they're going in is at, their exit should be higher. Rent growth, you generally don't want to see it more than 3%. And if you're in markets like Sunbelt, I'd probably be looking at like 1% rent growth, if that, over the next couple of years. And the last part is leverage. Like we use between, depending on the deal, like let's call it 55 to 70% loan to cost. Industrial is usually going to be on the lower end of that. Sometimes you'll see people, they're levered up to 80% of costs. Like that's where you can get in trouble. Too much debt, aggressive underwriting through rent growth, and compressing cap rates. Those are kind of the three things that you want to pay attention to that really move the model. And that's how you can show these, eye-watering type of returns.
Yeah, I've definitely seen that and noticed that with the rent growth too. And even on like the individual, you know, small multifamily properties and stuff there where people are investing directly, that you'll see them kind of come up with these rent numbers. And once you get in and actually start investing, you realize, yeah, you can increase rents sometimes, but it's not as easy as just going, oh, we're increasing them, 25% or something like that.
Yeah,
And you can really fool yourself there. And I
yeah.
saw a lot, and I'm sure you did too, especially as the interest rates started to grow. Like all of a sudden, with the underwriting, people started kind of almost trying to bake in more rent growth to compensate for that, and it just definitely seen people get burned, as I'm sure you have.
Oh yeah, 100%.
Um,
That was something we saw comp a lot during that 2020, 2022 run for sure.
yeah. So Alden has a great question here. Are all the investment opportunities individual properties, more like a syndication model, or are there funds of properties for more diversification? And then follow up to that, what does typical minimal and minimum investment look like?
Yeah, so I mean, is there such a thing? There absolutely are. I mean, when it comes to passive investing, you have the opportunity to invest in individual deals or invest in funds. And then once you do funds, there are different types of funds. You have what's called a drawdown, a close-ended fund. So when you hear the term close-end, what that means is I invest $100,000 now, fund is going to close in 5 years, and then they sell all the properties, I get my money back. So you'll hear a closed-ended fund structure. What you're seeing more popular now is what's called evergreen fund structures. So these are essentially private REITs that stay open for forever, generally income focused. So those are really your options in the fund world. We don't do any of either. We do individual deals, and that's very intentional. The reason why we focus on individual deals is because when you're in a fund structure, you have timing constraints on both the purchase and sale of those investments. And as someone that used to work for a fund manager, I've watched those specific dynamics negatively impact the overall returns. Because typically in a fund, you have what's called a deployment window. So you can deploy capital over, I'm speaking specifically more about closed-ended funds, 1 to 2 years. Well, if you raise $200 million, now you got to go deploy it in 2 years. Well, as you're getting to the end of 2 years, if they still haven't found deals, well, they're not given the money back generally, right? So then they're going to go deploy it into maybe a property that they wouldn't otherwise would. On the back end, same thing. As they need to unload assets, if they're having trouble doing it, or and if they don't want to go for an extension, maybe they're not selling properties for every or all they're worth just to wind down the fund. So what we like to do is invest in deals where we want to invest, when we want to invest them, and make very high conviction type of bets. Now, we're not saying don't diversify. What we're saying is invest little amounts in different deals over time. That gives you something that's less talked about in real estate when you're investing. It's called vintage diversification. So what that means is, as an example, no different than if you think about wine, right? If you buy a bad year in wine, like it doesn't matter what type of wine you buy in that year, if it's all going to be bad in one specific region of the country. You can think of that same concept in real estate, which is if you invested in 2021, most likely you didn't do well, right? Because pricing had gone through the roof because of a lot of the dynamics I talked about earlier as it relates to interest rates and overall appetite for real estate at the time. Conversely, now if you're investing in 25 vintage, 26 vintage, or like these are vintages that might do well. So I really much am a believer that you want to, and we believe at Lightstone, we buy some assets every single year, right? And so that you're diversified across different assets, different vintages, different parts of the market.
Awesome. And in terms of typical minimum investment for you guys.
For us, our stated minimum is 100. We can take as low as 50.
Okay.
But if you look at our materials, you'll see 100, but we can take as low as 50, especially being, obviously knowing Jordan.
Okay. And Samuel's a great question. How are most folks funding these investments if they're 50 to 100K, paying cash, or getting a margin loan? I don't necessarily recommend that.
Yeah, wouldn't
But
recommend
maybe
that
that's an
either.
opportunity to talk about like, are you self-directed IRAs? Is that something you guys take and do and maybe different options there?
Yeah, I mean, I would second that last part. Definitely, we wouldn't recommend taking out a margin loan. I would say most are almost all are taking cash. But yeah, to Jordan's point, you can invest through retirement accounts as well. There are things you have to be careful of when you're investing through an IRA as it relates to real estate specifically. I think this might just be a useful piece of information to anyone on the call. If you're investing through a self-directed IRA into real estate, if the property is going to be leveraged and there's going to be debt on the property, that can actually create a taxable event in your IRA. It's called the Unrelated Business Taxable Income. UBTI is the acronym. And so you just need to be careful about that. So we have investors that don't care. Maybe they generate losses from other parts of their portfolio, but it is something just to be aware of is that it can trigger a taxable event inside your IRA. But yeah, we work with custodians like Directed IRA, Equity Trust, many others out there. So
Awesome. Another question, what are some red flags to look for that in companies that are starting to make deals or put deals out there again in this rebound? Is it the co-investment percentage like you guys have? I mean, that's a really unique thing, like how much you
yeah.
guys invest in your model.
Yeah.
But yeah, it's a great question because we saw as you went through the cycle, there everybody and their mother was, a deal sponsor in when the interest rates were super low, and then you saw people getting burned by variable rate interest rates and just people who were not experienced with underwriting. So what folks on this call, whoever's watching, that are looking to invest and create passive income, what are some red flags they need to look out for?
Yeah, I mean, I think, I talked about one of them, which is debt. Debt leverage is a big one. Obviously, how they underwrite rent growth is a big one. I think it's understanding what I tell anybody that's thinking about investing passively is you want to underwrite the manager more than the individual investment itself, right? And the reason why I say that is because, yeah, you want to understand, have they done this before? I've talked to many investors and I work with a ton of physicians, people that have, managers that maybe all they did was multifamily and then they decided to do self-storage. And I actually heard a story the other day it was a group out of Chicago that had done multifamily. Then they moved to storage. The first storage deal went really well, so they like tripled down, and then none of those did well, and it was like a catastrophe. And so I think, you don't want to be the guinea pig as someone is venturing off into a new market or be a new property asset class that they've never done before.
Hmm.
Because it doesn't sound like a big deal moving into a different market, but it can be, right? I think there's nuance to that. Like as an example, we're getting ready to do a deal in Grand Rapids, a multifamily deal. We own 10,000 units across Ann Arbor, suburbs of Detroit, different parts of, but we don't own in Ann Arbor, but it's close enough, right?
Yeah.
But it'd be one thing for us to go to California and deal with, like, that's just a whole different ball game as far as investing, from especially as it relates to residential. So
Yeah.
I think those are things I would look for. Co-investment's a big one. I mean, if they're not willing to put their own money in the deal, like I always go back to this Charlie Munger quote, and I've found it to be more true about in so many part aspects of life, which is, show me the incentives and I'll show you the outcome,
Yeah.
right? And it's such a great quote, and I can't tell you how many times I'm like watching something happening unfold on the news, whether it's in publicly traded markets or whether it's in private real estate, private markets. It's like you find out that the incentives just weren't there,
We're in
right?
a line. Yeah.
Mhm.
Totally. Um, Alden has a great question here. Can you comment on your thoughts about whether investments like these are good or not good for people who are at or near retirement age?
Yeah, look, I think that's a great question. And I think that's when, anytime we're talking with one of the big part of our process at Lightstone and my team, what we work on specifically is in the discovery process is this question, right? Is this type of investment right for you? Like, because whether you're investing, whether you're buying your own property or you're investing passively, I mean, there is not the liquidity. Like it's not like you're investing in the stock market where you can get out immediately.
Mhm.
And there's some funds that like to tell you that that's how it's like, but it's really not. I mean, it can be. So liquidity is an important aspect for that. Sometimes, especially when I'm talking with people that are at that age of retirement, a lot of it comes down to sizing. So it's, really maybe just doing the minimum investment because they want that tax efficient income that's a bit higher yield, or just have a level of comfort with the asset class or a specific market that they can get comfortable with. They don't want to deal with the volatility of the public markets. But yeah, I think it's something that, it's really tough. I really leave that to the individual to make that decision on behalf of themselves. What my job is and what I want to make sure that any investor or prospective investor does when it relates to our offerings is you understand what the risks are. Because anyone that tells you that it's risk-free or, like that's a red
Run
flag.
the other
So
way. Yeah.
yeah, back to the question earlier, like what are red flags? Someone telling you this is a no lose deal, you should probably think twice, because they all have risk, but it's a really good question. And I think everybody's different about where you are. And I think what's most important too is you want to be able to sleep, like you want peace of mind.
Hmm.
And so sometimes during our discovery calls, like we quickly realize like this isn't for you, and that's all right. Like what we want, we don't want any of our investors to be, and you shouldn't want this either, to be worried like, if something small in the market happens and if you're just not able to, like if you're restless about the investment because you're retiring or because you're trying to put your kids through school or whatever, like it may not be you, or maybe it's just not the right time, right? So long-winded answer, but hopefully that helps provide some clarity to that question.
Yeah, I think definitely. And it's about what you're looking for out of that money. It is
Yeah.
always the case. And I think, like you said, this is a great way to generate tax efficient and income, passive income, stuff like that. But it has to make sense for your situation, what you're looking for it to do. Are
Mhm.
you looking to grow or are you looking more just to maintain? So yeah, no, great nuanced answer to a nuanced question. And here, a great one to finish up on, before we kind of talk a little bit about how folks can get in contact with you. Samuel asking, what kind of fees do you have? How does that structure look like with Lightstone?
Yeah. So with all alternative investments in general, fee structures are a bit different than maybe what you're accustomed to on like whether you're looking at publicly traded securities like ETFs or anything like that. So that's just an important point to mention. But so usually our fees are kind of broken out into four different categories. Is you have a one-time acquisition fee that we charge up front, and that can vary between 75 basis points to 1.5%, depending on how much someone invests. We charge a 1% annual asset management fee. Again, that's for our deal team to actually go out and manage these assets on a day-to-day basis. We also charge construction if there's a CapEx component to the underlying business plan. There's usually a construction management fee associated with that. Um, and then there's what's called the manager performance fee or the incentive fee. And what that is, and you'll hear that term called carried interest, performance fee, manager incentive fee, whether it's private equity or private real estate. What that essentially means is that is a fee that only gets earned if we meet a certain return for our investors. So in our case, what that means is before we actually earn that fee, investors have to earn their capital back plus an 8% cumulative and compounding preferred return first. So just to keep like the math simple, if you invest $100,000 and you have a 4-year deal, what that means is we basically owe you a 36% return on your investment plus your capital back. After that, we start earning 20 cents on every dollar thereafter, right? And so when we target a 15% IRR, we target in 6 to 9% distributions. That is after everything we just talked about, right? So what we don't do is put out returns and then make our investors do the mental gymnastics of saying, okay, 15 IRR, well, then I got to deduct this fee, this fee, and this fee.
Yeah.
So we always like to show on like a pro forma. And I think that is very different about how we do things at Lightstone, because I think it is different for somebody that isn't live and breathes in this space every day. Anytime I'm talking to someone on a discovery call, I want to show the terms on a page, but then I want to show you how that actually looks in a model. So you can see how it gets charged and how that flows down to your investor cash flows so that you can. I'm a visual guy. I like to see out on a table, like what it looks like and how that works versus just seeing the term. Good question. And I'm happy to expand on that if anyone wants to dive more into the conversation on fees.
Yeah, that's definitely important anytime you're vetting a deal or a sponsor to ask what is your return, your IRR net of fees. Because that's definitely a tricky thing that some people will try to camouflage, but any good
100%.
sponsor should be saying, no, this is exactly what it is. These are our fees, very transparent. Um,
Yeah, like if you're looking at a deck and you don't see the fees, it's gonna be, you
yeah,
sometimes that's it's because you'll see things like financing fees, disposition fees, um, very above market acquisition fees. Like there's just so many different ways to skin the cat there. And sometimes, the part that is unfortunate about our space is I wish it was press a button, and then you could buy it and like it was more. And I think that day is coming. But for now, like you get a PPM and it's kind of daunting if you're not in the space, right? Like it's a 60-page PPM. And so that's why our team, we make sure that we have someone like myself or any of my team members to kind of walk people through those
yeah.
conversations.
Yeah, exactly. It's like, if you're talking to a patient, whether it's you're describing them some new drug that they're going to go on or a surgery or something like that, like it's never that there's never any risks or potential side effects or something. And you have to disclose everything. And it's not like if you're finding someone or if you're going to doctors going like, no, there's no side effects or there's no risks to my surgery, like then there's something up. Um,
100%.
so, Jonathan, as we're reaching the end of our time here, how will everyone who registered will be following up, with very easy ways to follow to get in contact with you. But anyone who's watching the recording or anyone who wants to learn more even tonight, what's the best way to get in touch or learn more about Lightstone Direct?
Yeah, I would say, look, you can go to our website, lightstonedirect.com. If you want to get in touch with me directly, my email is jspitz at lightstonedirect.com. I think we'll send around the deck and it'll be on our deck. At the end of our deck includes all my contact information. Feel free to shoot me an email, jspitz at lightstonedirect.com. Would love to connect with anybody on the call, talk about anything we discussed tonight or your specific situation and how we can help.
Awesome. Well, thank you to everyone joining either live or asynchronously. And Jonathan, thank you so much for spending time with us and sharing your knowledge. I know I definitely learned a ton, and I think everyone did as well. So thank you.
Awesome. Yeah, thanks, Jordan. Take care. Good
All
night,
right.
everyone.
Bye, everyone.
Bye.